Hey, everybody, and welcome to the 11th episode of the Crowdsourcing Sustainability Podcast. In this episode, I will be joined by Ian Monroe, who is the co founder of Etho Capital. And before diving in, I just want to make sure you know two things. I gotta do my due diligence here. The first is we talk about sustainable investing and financial markets. I just want to make sure that you know that this is not financial advice. You have to do your own homework on that stuff. The second thing is that I want to make sure you know that I actually invested in Etho, which is the ETF that Ian's company created. And I invested in it back in 2015 before I knew who Ian even was. And I did that because today it's hard to find sustainable investments. And back then it was even harder. And yeah, it was just something I was looking for. And, now we're kind of full circle. I'm talking to the guy who created it, which is cool. But I just want to make sure you knew that, and I don't believe it impacts the conversation at all, but just a heads up. So yes, without further ado, we will move on to the show, and I hope you enjoy. Today, we are lucky enough to be with Ian Monroe, the founder of Etho Capital, which is working to create the world's most sustainable investments. Prior to Etho Capital, Ian consulted on sustainable solutions in over 30 countries for nonprofits, the United Nations, the World Bank, and the U.S. Department of State. He's currently a professor at Stanford in the Earth Systems program, and he founded Oroeco, which is an app that helps individuals reverse climate change by measuring and gamifying their carbon footprint. So Ian, welcome to the show.
Thanks a lot for having me.
So we're going to dive into sustainable investing, ESGs, greenwashing, divesting versus engaging with fossil fuel companies, what the average person's investments look like through a sustainability lens, and much more. But like with all my guests, I'd like to start by just taking a step back and hearing more about your climate journey, especially how it started. So when did you decide to work on climate and why?
So it definitely was at a relatively early age, I guess. I've been working on climate in one way, shape, or form pretty much my whole professional career. And it really started from growing up on this small farm slash ranch in Northern California in the wilds of Mendocino County. If any of your listeners know where that's at, it's a few hours north of San Francisco. And I grew up just seeing the impacts of climate change without even realizing that's what it was necessarily early on, seeing that drought was increasingly becoming an issue. And at an early age, I started being really worried about wildfire. And then as I saw the science around increasing drought and just more variable extreme rainfall in the area, and started thinking about what that meant in terms of what we could grow on our farm and the forests around us, and what it meant in terms of wildfire risk, which is something I always had nightmares about as a little kid. That steered me into, wow, this climate change thing is a huge problem, and we really need to find solutions to it. So I went to college with a focus on what can I do to help solve this climate problem, and initially really focused on the science and engineering side of things. I thought I would be inventing new renewable energy technologies and helping implement those in maybe the public policy context. But overall, my early interest and focus on climate change just came from growing up in this beautiful place surrounded by nature and seeing the impacts here, and then getting worried about the impacts, not just here, but around the rest of the world as well.
Wow. So yeah, that deeply personal from a very young age, it sounds like. Was it something that your family actively talked about, or more you could just put the pieces together and then once you eventually heard of climate, it kind of clicked, or what was that like?
Yeah, I'd say sustainability certainly was something that my family actively talked about. I grew up with my mom here on the ranch, surrounded by this bigger community of folks that were into sustainability kind of long before it was cool. A lot of it
Mm-hmm.
tracing back to the 70s and the Back to the Lander movement that my mom and her friends were connected to. So I grew up around folks doing organic and biodynamic farming long before it was mainstream, when it was still kind of a crunchy hippie thing, and also folks doing off-grid renewable energy long before renewables were a mainstream grid scale sort of thing. So it certainly was something that the broader context of sustainability and concern early on about what the science was saying about climate change, those things were around me, and things that I was made aware of at a relatively early age.
Gotcha. And can you briefly walk us through sort of the rest of your journey? Like, how did you get to where you are today?
I went to college focusing on how I could help scale up solutions to climate change. And I studied in the Earth Systems program at Stanford University with a focus on renewable energy and also forest ecology and how those things fit into the context of international development as well, with a minor in international relations. And when I graduated, I really thought I was going to be a scientist or engineer or maybe in the policy sphere. So my career trajectory took me into international development, renewable deployment, and sustainable forest management, working with a number of different nonprofits and collaborating with folks at World Bank and State Department and other entities, large and small, around the world that were working on scaling up climate solutions. And that work was really interesting and really rewarding and gave me a lot of experiences that really helped me connect with just the scale of the climate problem and all the issues related to land use and renewables and our broader energy and food and materials infrastructure that needs to be re-engineered for climate solutions. The more I worked in the kind of science plus policy world in, over 24 countries around the world at this point,
Wow.
the more I realized that I wanted to be working on more systemic change rather than just project by project work. And that brought me back to Stanford, where I got invited to start teaching courses on climate sustainability and scaling up climate solutions and looking at social and environmental trade-offs as we scale up climate solutions. And as I was doing that, particularly coming out of the work that I had done in China, I started thinking about what can we take about the science related to life cycle, climate, and other impacts, and connect that science to our everyday decision making and try to make that fun and rewarding in the way that the mobile app ecosystem has made social gaming a mainstream thing that actually is driving behavior change. So that led me to help found a platform called Oroeco to track personal impacts on climate change and turn that into a social game and try to make it fun and rewarding and easy for us all to take climate action and feel like we're not doing it alone as a drop in the bucket, but we're part of this connected ocean of community action that's really driving substantial change. And so I have gone through this evolution of being a sustainability science and engineering geek to a policy wonk and partially in academia to then in the tech world as well. And then out of Oroeco, we started looking at the climate impacts of your personal investment portfolio. And we saw that actually companies that have less climate pollution for every dollar invested tend to financially perform better than their corporate peers. So essentially, climate leaders in pretty much every industry and sector of the economy that we looked at tend to financially just be better investments as well. And it was that aha moment that then took me from tech into the finance world with what we're doing with Etho Capital.
That is such a cool path. And yeah, it touches on so many different aspects of the issue. So I'd love to hear a bit more about Etho now, Etho Capital, and just would you describe how that works and the mission and how it's been going so far?
Yeah. So Etho Capital's mission is really big picture to move as much of the world's money as possible out of climate and overall ESG sustainability problems and into solutions and just show that it's more profitable for everybody to do so, more profitable for the planet and more profitable for investors and all of us that are connected up to those decisions and capital flows. So what Etho does currently, our focus has been our flagship investment fund. That's the Etho ETF. And behind that is an index of the most climate efficient, sustainable companies where we look at the total climate pollution per dollar invested for each company, importantly, including everything that's connected up to its supply chain, what in Climate Geek speak is Scope 3 emissions.
Yep.
And then we compare which companies have the best pollution profile, the least pollution per dollar invested, and find the climate leaders. And on top of that, we also do deep sustainability ESG screening to make sure there aren't other environmental, social, or governance risk factors associated with the companies that we select for the index. So we take out any companies whose core business models we consider just inherently unsustainable, like fossil fuel companies would be an obvious one, but also tobacco companies and weapons companies and private prisons companies. And then we take out companies that have other specific issues. So what we do is try to select the most sustainable, efficient companies and create a broad-based index that is really representative of the sustainability, climate, and otherwise leaders throughout the economy. And then we empower anybody to invest in it by turning it into what's called an ETF, an exchange traded fund. So that just trades on the New York Stock Exchange every day with the ETHO ticker. So that's what Etho is most known for. That's what we've been doing since the company launched in 2015. And now we're expanding into a number of other climate and overall ESG focused funds that we're making available to investors in different ways, trying to expand internationally more, and also working directly with some larger investors to look at their total portfolio-wide climate impacts and help them optimize those impacts, improve those impacts, while also improving financial performance at the same time of their overall investment portfolio.
That is awesome. Something you said in there, it's kind of the core thesis, it seems, is that these more climate efficient, less polluting companies are better investments. And I feel like the conventional wisdom for a while has been the opposite, that green companies are not great investments. And I'm curious to hear a bit about the history of sustainable investing and whether there was like a transition point when these became better investments, or if they always have been and there is some, gaslighting by the fossil fuel industry. Or could you just walk us through the history of sustainable investing and I guess if those returns have always been there?
Yeah, happy to. And certainly a core part of everything that we do at Etho is based on this thesis that more sustainable companies are just more efficiently run, generally better run companies that make for better investments as well. And we see there's this pretty direct link between climate pollution and overall operational efficiency and better investment performance that we think comes from the fact that climate pollution, unfortunately, is connected to almost every aspect of every company's supply chain. And so when you look at the most climate efficient companies in a wide range of industries, we think you're also just finding the companies that have better operational efficiency, and probably that ties to better management decision making. And really there's this positive feedback connection around climate and overall ESG sustainability and just a better investment profile for investors as well. But certainly in terms of the history of sustainable investing, that thesis has not always been the case. And a whole lot of investors still have this outdated view that sustainability somehow is going to sacrifice financial performance by limiting what you can invest in. And they don't have the view, as we do at Etho, that actually if you're doing sustainability screening in a smart way, and climate has to be a very big core piece of that, you're actually eliminating risk and highlighting opportunity and just creating a better diversified portfolio. So sustainable investing, it's been around for a long time in different ways. It's really something that started with predominantly faith-based investing that was value-aligned exclusionary investing. So
Mm-hmm.
different religious groups making sure that any endowment that the church had was invested in ways that didn't conflict with the values of that organization. And then that became more mainstream a few decades ago with the term socially responsible investing, or SRI. And essentially, that just was mainstreaming beyond the faith based community this concept of we should be investing our values. And so let's make sure we're excluding things that are in conflict with our values. And that generally was done with the assumption that excluding things might lead to lower financial performance, but the understanding that that would be okay because value alignment was paramount. And then that's evolved into what is most commonly used in terms of terminology now is ESG investing, which stands for environmental, social, and governance investing. And ESG investing is about going beyond just taking things out, but trying to get a broader sense of environmental, social, and governance metrics for every company that's considered, and not just taking out bad actors, but shifting towards leaders. The what I call ESG 1.0 investing that's been out there has been primarily focused on what companies disclose themselves in their corporate social responsibility reports, or CSR reports.
Mm-hmm.
And unfortunately, that's still how a lot of ESG investing is done. It's really reliant on these very widely used ESG data sets from providers like MSCI and Sustainalytics that mostly are just looking at what a company is saying in its CSR reports. And then if a company is saying nice things about itself, rating it highly in terms of policies related to environmental, social, and governance issues. Unfortunately, if you're relying on just self-reported data from companies, as you would probably expect, that data is generally controlled by marketing departments. It means that really a lot of the ESG data sets that are out there are actually ratings of which companies are best at saying nice things about themselves, not which companies are best at actually walking the talk. So that's a big thing that we try to do at Etho, is get beyond what companies say to what they're actually doing. And along those lines, there's also this really heavy bias in a lot of conventional ESG investing towards larger companies, because it's the larger companies that have the staff and their PR departments to do all the CSR reports and report to the various NGOs connected to those CSR reports, like CDP. And so that's the current status of sustainable investing, at least in the public equity space, is there's a lot of focus around ESG still 1.0 investing. And that focus hasn't historically actually even factored in climate change in a big way. If you look at a lot of the ESG funds, even those that are still out there, they don't necessarily take out fossil fuel companies. In some cases, they actually give fossil fuel companies relatively high ESG ratings. There are some strategies that have
Insane.
shifted towards taking out fossil fuel companies, but there are new strategies coming out. It seems like on a weekly basis now that have an ESG label. But if you actually look at the holdings, they still may be filled with fossil fuel companies and a bunch of other companies that your average person concerned about sustainability and social responsibility would have pretty serious issues with. For example, BlackRock just came out with 2 climate themed funds that have almost every oil major in them. So there there is, I think, a big need for any investors considering shifting their money towards climate and overall ESG sustainable funds. There's a big need to look beyond the label at the actual holdings and make sure those actual holdings are in alignment with their values, or at least look at what the mandate is for the fund. And if it's an index fund, the index that's behind that fund. So that's the current status of ESG. Is certainly the rhetoric has moved in the right direction, and the mainstream of that rhetoric is great to see. And it's great to see so many investors signing on to the concept that sustainability, if done right, doesn't sacrifice financial performance, but actually can enhance it by, again, taking out risks and shifting towards opportunities. Unfortunately, there's still a decently large gap for a lot of large asset owners as well as funds that are out there between nice sounding labels and rhetoric and the reality of the holdings that are actually in the strategies. So that's the current status of ESG investing that we're trying to help fix with what we're doing with Etho is a real need to shift beyond just rhetoric to reality. And I think the direction that sustainable investing is going is increased focus on climate and overall net positive impact, and making sure that impact for an investment fund that is claiming to be ESG sustainable and climate focused is actually net positive in the direction of climate improvement and shifting money out of ESG problems into solutions. And so we're trying to contribute to that shift with what we're doing at Etho, which is really science driven and trying to get at the reality of what a company is doing as opposed to just what a company says it's doing.
Yeah, that was super helpful. And there's a lot to unpack there. I'm curious, I guess, first of all, just to make sure I'm thinking of this properly. So within the ESG space, are you saying there's kind of this greenwashing section where, companies are putting in the fossil fuel companies within these funds, ETFs, whatever they may be, and those are kind of just, they're trying to take advantage of the sustainable investing trend, and those aren't actually clean or good at all, really. And then there's this second layer that you call the ESG 1.0, which is, hopefully, ideally, no fossil fuel investments, but they're taking these companies at their word and what they're self-reporting, and they're not really looking under the hood to see if they're walking the walk as well, or maybe they're not looking at scope 3 and they're only looking at scopes 1 and 2 or something like that. And then there's this third, which I'm assuming you would call ESG 2.0, which is actually looking under the hood and making sure to do due diligence on that, not just trusting that they're doing what they say they're doing. Is that like, would you break it up like that? Would you break it up differently? And I'm curious, what percentage of ESGs would fall into each bucket, do you think, right now?
Yeah, I can't give you a percentage off the top of my head, partially just because it's hard to keep up the space, even though we're right in the middle of it with Etho. When we started the Etho ETF, combining a climate focus, particularly a quantitative climate focus that looked at scope 3 emissions with overall deeper ESG, was a pretty new thing. Etho was the first broadly diversified ETF, at least in the US, that had this combination of climate screening and overall ESG screening. Since then, there is a whole lot of just mainstreaming. There's been a big mainstreaming of the concept that ESG is important, the realization that investors increasingly are saying they want it. It's now over 70% of investors overall are saying they want ESG. You have trillions of dollars, actually over 80 trillions of dollars signed on to different ESG related pledges, like the UN Principles on Responsible Investing. But there's still all these issues that we were just talking about. And there has been, it's hard to tell if, I think the number of solutions that are real solutions in the ESG investing space percentage wise has actually been going down, but that's just because essentially every financial product creator is creating something because there's so much demand that they perceive that if you're in the investment product space, you have to be talking about ESG and putting out some ESG products just to be considered relevant and competitive. So certainly all the larger investment shops are doing it now. Uh, I don't want to say that the ESG 1.0 approach, as we're calling it, is worse than nothing. It certainly does in most cases reflect marginal improvements. In many cases, as I mentioned, they're not even taking out fossil fuel companies. They would just have a lower percentage of fossil fuel companies in their holdings, or they'd shift to the ones that they think are marginally better. But a lot of what's out there, at least in the conventional index fund ETF space, it has some pretty serious issues with it when you really start looking at the holdings that are in the funds. I don't want to say that Etho is the only one trying to do this authentically. There certainly are other sustainable investing groups, many that do take climate into account quite seriously. Historically, they've more been in the mutual fund space. And so the issue there is they're just creating more concentrated funds that have higher management fees that have a bit more variability, but over time generally have performed well as well. It's the broad-based index space, like the space that the Etho ETF is in, where there are more challenges with the type of funds that we see out there. And a lot of those challenges connect up to outdated ways of thinking about diversified index investing. And that's one of the things that we've been trying to solve with Etho is with index investing, you're effectively trying to invest in as broad a swath of the market as possible. And there's a lot of data that shows when you invest in a broad-based index like the S&P 500 or globally the MSCI ACWI All Country All World Index, on average, you tend to do better than active concentrated funds that invest in those same geographies. So an active mutual fund investing in the US market on average does worse than the S&P 500. And there's a lot of data that just shows this has been the case for decades. And it's actually the founder of Vanguard was one of the first to really popularize this idea of index investing. And that's effectively what the whole firm has been built on. So what Etho is showing is that, yes, investing in a really broad-based index of companies tends to be a better way to invest, but you can create that broad-based index of companies in a much smarter way from a sustainability perspective and from a financial performance risk-return perspective, rather than just creating an index of the largest companies in the US, like is essentially what the S&P 500 is, with a relatively arbitrary cutoff. You can create a diversified index of the most efficient, sustainable ones and actually perform even better. And that's what we've been showing with Etho. But that is still really, really rare in the broad-based index world. Traditionally, ESG sustainable investing has been done much more in the context of active, concentrated fund selection, like mutual funds that just have 30 to 50 holdings in them, as opposed to in the broader index context, like with Etho, where we have hundreds of holdings. And that's just something that does need to change, because right now, conventional index funds are effectively creating a zombie flow of capital towards fossil fuel companies and other companies connected to climate and sustainability problems. And there's been this continuous shift towards diversified index investing, particularly done by the largest asset owners in the world, the public pension funds and sovereign wealth funds, again, because of this awareness that diversified indexes tend to financially perform better, and they also have much lower management fees and is a cheaper way to go. But if that status quo continues and we keep shifting all these trillions of dollars to conventional index funds, we continue to shift a portion of that to the fossil fuel companies and other climate sustainability and ESG problems that are associated with those conventional indexes, since those indexes are filled with effectively all the large fossil fuel companies and other ESG sustainability problem companies.
Yeah. So I have a few things. I guess I'm curious first. You said there are some other folks who are doing a good job in your eyes, authentically trying to get at the most sustainable companies? And I think you said they're more on the mutual fund side, but do you want to give any shout outs to other folks doing a good job in this space in your eyes? From like the, climate strategic side of this?
Yeah, sure. There's and apologies, I'm pretty U.S. centric in my view of the ESG marketplace, just because I spend the most time here for obvious reasons. So definitely, I'd give a shout out to Change Finance, which has an ETF that's also a fossil free ETF. It's a bit more concentrated. It's a large cap fossil free ETF. And they're not doing, as far as I'm aware, the type of scope 3 climate impact analysis that we're doing, but they are authentically, I think, really trained to take climate and overall ESG into account with what they're doing at Change Finance. Um, they've also performed quite well, very similar to Etho. And then there's folks that have been doing it even longer in the mutual fund space that I do think are authentically really trying to do it as well as they can. I'm not aware of them also doing the kind of scope 3 deeper dive climate impact analysis we do for supply chain and now the downstream climate impact of the products and services that companies put out into the world. One company that's been around for a while that I think is doing good things is Green Century. And there are a number of others out there in the mutual fund space. And there are folks that are doing great things in the advising space and ESG data space as well, like Hip Investor here in the Bay Area, I'm a fan of, and also NIA, which is focused on gender lens and overall diversity and inclusion investing. And so there's a lot of folks that are doing cool things that are climate adjacent and then also trying to factor in climate as well. And there's a group that we've partnered up with in the Bay Area called New Day that's helping make investment strategies accessible to everyone that previously were just accessible to wealthier investors using a wrapper called a separately managed account. So we're excited to be working with New Day on climate and overall ESG integrated strategies that are accessible to investors in ways that other funds aren't.
That's awesome. So one of the things I want to clarify for anyone listening, because we've mentioned it a few times, and you can elaborate on what I'm going to say here, because I'm sure you know it better. But scope 3 emissions are really the emissions in the supply chain of a company, is my understanding, and it actually accounts for something like 80 or 85% of that company's total emissions. So it's no small thing that a lot of the ESG funds are ignoring this massive piece of the puzzle here.
Yeah.
And so I'm curious, one, would you elaborate or explain that any differently than I just did? And then also, what percent of funds out there are actually looking at scope 3 or incorporating it?
Yes. So again, I can't give you a percentage off the top of my head, but I'm guessing it's less than 1% is looking at scope 3 and incorporating it in any systematic way. And as you mentioned, scope 3 is actually, for the vast majority of the companies, the biggest source of their climate impacts. So for those of you who aren't climate geeks yet, but aspiring to be, you'll often hear this terminology in the climate world: scope 1, scope 2, scope 3. Scope 1 emissions for a company is what a company is directly doing within its facilities. So if a company burns natural gas as part of its production process, that would count as scope 1 emissions. Scope 2 emissions are connected up to a company's electricity use. So most companies, of course, use electricity in their operations in some way, shape, or form, whether it's just lighting in an office building or more use for an industrial process. And so scope 2 emissions are the emissions that are connected up to that electricity use by the company. And then scope 3 is effectively everything else, both upstream and downstream. So on the upstream side, scope 3 is everything that's connected up to the supply chain, all the products and services that go into making whatever a company does in terms of their own products and services. So if a company is making t-shirts, for example, all the cotton and the dyeing and spinning process, that would all fit into scope 3 supply chain. And also on the downstream side of things, scope 3 includes everything connected up with the use of the products and services that a company is putting out into the world. And this is particularly important for a fossil fuel company, because a fossil fuel company has scope 3 emissions that are associated with the production of their fossil fuels in terms of natural gas leakage, for example, out of oil wells, and leakage throughout the pipeline system. But in a lot of carbon accounting that's done for investing, the fact that a fossil fuel company's core products, their fuels, emit a huge amount of climate pollution when those fuels are used, that actually doesn't get factored into the climate footprint conventionally for companies like Exxon and Chevron, for example, because that's considered downstream scope 3. So for Etho, we look as much as possible at the full climate impacts, importantly, including the scope 3, which in many cases, scope 3 is not even just 80% of a company's climate impacts. It can even be 99% of a company's climate impacts. Which is the case actually for Apple, for example. By Apple's own calculations, the vast majority of the emissions for Apple as a company aren't connected up to its spaceship-shaped headquarters in Cupertino, California, which has solar panels all over the roof and has done a lot of other great sustainability things. But the emissions for Apple predominantly are connected to all the different suppliers and the raw materials that make their computers and make their phones and other gadgets that they sell, and then also to a lesser extent connected to the electricity used when people are using those gadgets. So with Etho, as much as possible, we're trying to look at the full climate story and incorporate that into our decision making about which company is really a climate leader. And that, as far as we've seen, is still really rare. And part of it is because I think a lot of investors just don't know how to do it. We've been in a unique spot for Etho in that we have a team primarily composed of climate and engineering geeks that have come out of the world of carbon accounting and scope 1, 2, and 3, as opposed to folks that have come out of traditional finance. We have that on our team as well. But a lot of the different groups doing sustainable investing now, or what they call ESG sustainable investing, are just working with data sets that are the most popular, most heavily marketed off the shelf things that are out there. And in most cases, those data sets, if they include climate information at all, it's climate information predominantly just related to scope 1 and scope 2. So you're missing over 80%, in some cases 99% of the picture for companies. And then, of course, the vast majority of strategies that are out there still are not even looking at ESG factors and climate in particular. So even amongst the minority of funds that are looking at climate, it's quite rare to be looking at the real complete picture that we're trying to get a better sense of with Etho.
That was super helpful. Thank you. So I might jump around here a little bit, but I kind of want to get into the risk of investing in fossil fuels. This affects individuals because if you're invested in these pension funds, like you said, some of those are the largest funds out there right now. And I think people have a lot more exposure to this than they realize. I remember I wrote about this topic a couple of years ago now, and I believe at the time, at least, the average exposure people had to fossil fuels was something like 5 or 7% maybe in their portfolio. And I'm just curious, does that sound right to you, that level of investment just in your average 401k or whatever, if you're not really paying attention to it, or you're just, diversifying throughout the market or doing what the financial experts are saying? And then in addition to that, are investment managers breaking their fiduciary responsibility at this point because of how risky fossil fuel assets are. Because I also know, Bill McKibben had this awesome article a while ago now called, the scary math of global warming, something like that. And, it's been updated every so often since then. But the basic gist is that these fossil fuel companies have a certain amount of value, or most of their value, on their balance sheets, are saying we have this many fossil fuels underground right now. We're going to sell them all. And just the math of the situation, the climate math, is that we cannot burn all of those fossil fuels and limit warming to the 1.5 or 2 degrees targets that we've set out as the max limit, because beyond that is quote unquote catastrophic. We got to limit this to these thresholds, or limit warming as much as possible because of how damaging and destructive it is. So just there's this math behind it that we can't burn all these fossil fuels. These things that we really can't burn are still on these balance sheets, and there could be stranded assets. And I'm curious, this is very long-winded, but at what point are people in the financial space breaking their fiduciary responsibility to their clients?
Yeah, well, I certainly think we're actually long past the point where any portfolio manager, particularly those that have a fiduciary duty to manage a public pension, for example, which has all these beneficiaries that have paid into it, if they're not looking to divest from fossil fuels as quickly as they can at this point, I think there's a very strong argument that they're in violation of their fiduciary duty. And it comes from a couple different angles. One is what you essentially already talked about, that we're already long past where we need to be in terms of climate pollution, in terms of the thresholds of which there's a safe level, whatever a safe level of pollution is in the atmosphere.
Yeah.
We really, the only scientifically defensible target right now is to reduce pollution to zero as quickly as possible, do it as much as possible within the context of a company or a portfolio, and then for whatever can't be reduced, have offsets, or even better, payments for carbon removals that actually suck the pollution that's in the atmosphere out of the atmosphere. And really getting to net zero as quickly as possible for every company, every government, every individual, and every investment portfolio is where we need to be aiming. And that certainly still, unfortunately, isn't the case. There is, thankfully, a movement towards net zero rhetoric that I think also has accelerated a lot recently, going alongside the UN FCC report on the 1.5 degree warming target, and how we're already getting quite close to hitting that. And the world needs to do a whole lot more, including companies and investors. So there's been increased realization that everybody effectively needs to be aiming towards net zero. Still, the net zero targets that are coming out there for companies and investors often are saying net zero by 2050. And if you look at the climate science, as I talk about with my students at Stanford, that's really not soon enough. We really need to be talking about net zero by 2040, ideally 2030. And for those that can afford to do so, which a whole lot of the large investors certainly can, we need to be looking at effectively net zero now, and even getting to net positive. And that is just a shift in mindset and a shift in urgency that really still needs to happen. If you look at fiduciary duty and fossil fuel investments, there's also a really compelling argument to be made that assets will get stranded in the ground, not just because of climate policy, which, if you look at all the targets of the Paris Agreement, the vast majority of the world's fossil fuel reserves can't be extracted and burned. And those reserves, of course, are on the books and accounted into the balance sheets and valuations for fossil fuel companies. And effectively, that's value that just will never be realized. and actually becomes a big liability. But it's not just about climate policy targets and stranded assets related to those policy targets. Actually, the bigger, really exciting success stories I know you've talked about in crowdsourcing sustainability is the fact that clean, green, renewable alternatives are just better and cheaper in almost every market in the world now because of the exponential decrease in the cost of solar and the cost of wind, and now more recently, the cost of battery technology and electric vehicles. Fossil fuels effectively have become technologically obsolete. So it's actually policies and kind of corrupt connections to politicians that in many cases are propping up fossil fuels that just are no longer economically competitive. And that's been the case for coal for a while in a lot of places. And it's rapidly becoming the case for oil and gas as well, because of how cheap solar and wind and batteries and EVs are becoming, and only projected to become cheaper and cheaper. So actually, I think the even more compelling argument about stranded assets and fiduciary duty connects up to just what's going on with technological change and associated economics in the energy and transportation spaces, where electric vehicles and batteries and solar wind are going to kill oil, gas, and coal far faster than policies ever have, just because of pure competitive market dynamics. And that's a great piece of good news, and it is a piece of news that investors really need to act on now. And it just makes fossil fuel companies look like horrible investments. And I don't see any strong argument that an investor can make that holding on to fossil fuel companies, particularly as long-term investments, is a good idea in any way, shape, or form. There has been this argument around fossil fuel divestment versus continuing to stay invested and engaging with the companies to try to help those companies shift towards not just being fossil fuel companies, but being diversified energy companies that also have renewable energy. And if you look at pretty much every fossil fuel company, at least the larger ones now, certainly the oil and gas majors, they have these divisions of the company that are investing in solar and wind and biofuels and other renewable technologies. And they've actually been doing that for decades. I personally I've lost count of the number of friends, probably dozens, who have worked with fossil fuel companies internally on those renewable and in some cases carbon removal and storage projects, with the thinking that they would be part of driving this transition in the company and driving the company towards solutions. Without exception, every company, or every friend rather, that's tried working within a fossil fuel company to help facilitate the change, they've come away from the experience saying this is just a bunch of PR BS and the company has no real plan to change. They're just trying to put on the vision of change to keep investors investing, to keep this narrative going and keep policymakers off their backs, to make it seem like the company actually has a future. And so they've left those companies and shifted to jobs where they felt like they could actually have impact. I had a pretty interesting personal window into the thinking that I think unfortunately underlies a lot of the fossil fuel companies behind the scenes, as opposed to the rhetoric that you get now from pretty much all the large fossil fuel companies. Publicly, they're saying, yes, climate change is a problem. We're working to transition ourselves to be diversified energy companies, and you should stay invested in us for those reasons. I had this fascinating experience where I ended up at an event sitting next to this guy who struck up a conversation with me. And he asked what I did. At that point, I was just focused on teaching climate solutions courses at Stanford. And he kind of laughed and said, well, you're probably not going to like me. And it turned out that he was a CEO of, I won't name the company, but one of the largest coal companies in the world. And this was close to a decade ago now. And so coal certainly was on the decline a bit. And obviously, all the climate pollution issues were very obvious already. And I brought these things up with him and how the competitive dynamics were changing with the cost of solar and wind, et cetera, getting cheaper and cheaper. And he basically said, look, candidly, I agree. I understand that coal is a big part of the climate problem. I think there's something to it. I'm personally doing some investments in solar, and my son is as well. But look on the other side of me, that guy next to me, he's my personal doctor, and he flies with me everywhere in my private jet. I'm worth over $100 million, and I enjoy this lifestyle, and I'm going to keep it up as long as I can. Flash forward now a decade, and what was one of the largest coal companies in the world has gone bankrupt. I don't think he cares. His money is in the bank. He has gotten probably a golden parachute out of that bankruptcy process, and probably they were successful in screwing over all their workers and shifting off liabilities for all the black lung and other health issues to a shell company. And basically, the mentality that is still running the oil, gas, and coal world, I think, is still really the robber baron mentality that the turn of the century made famous more than a century ago. It's still very alive and well. It's just behind the scenes. Yeah. But to become a top executive in a fossil fuel company, you kind of have to buy into that mentality, because the science has been obvious for decades. And actually, the fossil fuel companies, Exxon famously, have known that their core products are causing climate change for decades. And it's not just climate change. There's also very strong science that the core products are literally killing millions of people every year. There was a Harvard study that just came out a few months ago that found that pollution connected to fossil fuel companies was responsible, or is responsible rather, for over 8 million deaths per year. That's close to 20% of global deaths. So we're talking about an industry that very sound science is linking to 1 in 5 deaths around the planet, and has known about climate change for decades and decades. To think that that industry is going to magically actually transform any sort of reasonable time frame, I think is just really magical thinking. Yeah. And a core piece of that is it just comes down to core competencies in economics, where oil, gas, and coal companies are good at extracting oil, gas, and coal. And they realize that their core business is about selling as much oil, gas, and coal for as long as they possibly can, and keeping regulators off their back and keeping investors invested to continue to do so for as long as they possibly can. And the executives running these companies, I don't think they really care about whether the company is going to exist 50 years from now, or even 20 or 10 years from now, because in most cases, they know they will have cycled out. They will have personally made their millions, and the suckers that are left as investors will be caught holding the bag down the road. So my core view on divestment versus continuing to stay invested and engage with the company is that engagement can work and do a lot of great things if you're engaging to change a part of the company that isn't antithetical to a company's core business. But when a company's core business is driving the core problem, in the case of climate change and fossil fuel consumption and greenhouse gas emissions, the core business for an oil and gas and coal company is selling their products that create the problem. So they're never going to want to sell fewer products. They're just going to want to pull the wool over policymaker and investor eyes to keep them into that Ponzi scheme effectively at this point.
Yeah. I'm glad you brought that up, because I was going to ask you about that question exactly, the divesting versus trying to engage. And I have the same view. They've shown over the past 40, 50 years now that they're not good faith actors. And, they went from sowing doubt, denying climate change, to this, what Alex Steffen calls predatory delay. And I'm sure there's people doing great work on this, but part of me just thinks it's naive to think that they're actually going to change their core business. And to back up what you were saying as well, those inside stories were powerful. I haven't heard anything like that before, but it checks out. the stats that I've seen is something like 99 or 98% of their investments are in their core business. And so they'll invest in like 1% of their money in biofuels or something green or greenish. And that's the only thing they ever talk about
Right.
because they want to continue to have their social license to exist. But
1% of their investments and 99% of their advertising budget.
yeah, exactly. Kind of building on that. I mean, there's this predatory delay, they have so much political power. I'm curious to know, have you heard of the carbon bubble? The carbon bubble? I'd love to
Yeah.
hear you just share your thoughts on that and explain what it is for anyone who hasn't heard of it.
Yeah, so we're basically living in it, this carbon bubble. And it has, to give fossil fuel companies some degree of credit, it's been a lot of what has created modern society, right? The vast majority of the energy that's gotten society to where we have been and where we're going, or has gotten to society to this point, has come from fossil fuels, right? And connected up to all the climate pollution that still is in the atmosphere, even dating back to the beginning of the Industrial Revolution. Um, so, my understanding of the carbon bubble, at least, is that we are in this unique moment in time where we've extracted all this relatively magical source of energy to create the civilization that we have. But now we've gotten to the point that we realize that there are substantial consequences in terms of pollution and allowing our civilization to persist. Now that we have realized those consequences and also realized that we have better, cheaper alternatives in the form of renewables and EVs, for example, and also increasingly in the form of more sustainable food systems, that carbon bubble, I think, is popping and collapsing. And I know I rambled on in a few directions with your last questions, but one question I didn't tackle of yours yet is just what is the average exposure to fossil fuels for your average person, for your average investor who has an IRA or 401k, and you put out the number of 5 to 7% of their portfolio on average is invested in fossil fuel companies, even though they don't know it. And that was accurate in that your average index, like the S&P 500 for global benchmarks, particularly emerging markets, the fossil fuel percentages are even a bit higher. Again, the good news is that that percentage exposure has actually been decreasing. So if you look at the percentage of fossil fuel energy in the S&P 500 now, it's around half that, and that is because this carbon bubble is starting to collapse. Investors are realizing that effectively fossil fuel companies don't have a future, not just because of climate policy, but because we now have the better, cheaper technologies to supplant them. And so really their only future lies in the strategy that you mentioned, predatory delay, basically continuing to sell their products however they can, even if it requires corrupt connections with politicians that artificially prop up their industries and don't let the market dynamics of cheaper renewables effectively push them into bankruptcy. And I think that is ultimately where almost every fossil fuel major is going to go. Most of them are trying to make a case that, well, yes, we're shifting away from fossil fuels. There'll be some limited uses for a longer while, like aviation and jet fuel. But then the world still needs plastic. So we're going to continue to take out fossil fuels and they'll just turn into plastics and other physical products. And to a certain extent, that is somewhat true. But as I'm sure you and your listeners know, there's also been this big global movement to try to push away from plastics and to shift plastics to be bio-based plastics and not have the huge pollution issues connected up to plastic use, particularly single-use plastic. So I'm sure that we will continue to have plastics in our economy for probably a very, very long time into the future. But I think it's just as likely that they'll become a smaller and smaller part of our overall economic activity. And certainly the amount of fossil fuels that is needed for plastics production should be continuing to go down, particularly if we get our act together with the circular economy recycle systems that don't require new material from fossil fuels, but continue to reuse the material we already have and supplant it with bio-based materials that can actually sequester carbon in the process.
Yeah. Yeah. So going back a little bit, we mentioned that your average individual, um, I'm especially concerned about just regular folks here who have exposure to this carbon bubble of sorts that is deflating and, could deflate at different speeds depending on how quickly things happen. But what advice do you have for folks who, either want to limit exposure from that or want to align their investments with their values? What advice do you have for them to actually make that happen? And, that can either be ideally, I'm guessing it's two different paths here. There's the individual stuff if you have that, but then there's also your employer, like your 401k might be with your employer and you only have limited options there. So what advice do you have for folks to manage this risk and align their investments with their values, get out of fossil fuels if that's something that they want to do?
Well, certainly if you have your own retirement account, an IRA, a Roth IRA, etc., and you have direct control over what you invest in with effectively a really broad set of options. Looking at things like what we have with Etho, the Etho ETF, and other funds that are out there from other groups that I think are doing good, authentic work, like Change Finance, that's a relatively easy step, is just look at what you're currently doing. You can compare the performance in a free system like Morningstar of what you're currently doing versus sustainable options like Etho, and just see for yourself if it's giving you performance advantages. And certainly it should give you advantages in terms of climate alignment and overall ESG. For investing in Etho, it's as simple as putting the ETHO ticker symbol into whatever platform you're using, Vanguard, Fidelity, pretty much any of the major platforms, Robinhood. It's as easy as doing that. I should make the SEC happy and say past performance can't guarantee future results. If you look at Etho's performance, generally we've been substantially beating S&P 500 and other US benchmarks, but it wiggles up and down with the stock market because it's a broad-based index fund. So it effectively moves with the US market, and the global strategies we've created have effectively moved with the global market. And over time, we've generally seen this performance advantage building up, but it's not outperforming every minute of every day. If you are investing through employer's 401k plan, certainly it is more challenging because generally you will have just this limited menu option of funds that you can invest in. And unfortunately, the status quo is still that the vast majority of 401k plans don't even have a fossil-free alternative or an ESG aligned alternative. And so you may be stuck in a few options that basically guarantee that any of those options are investing in fossil fuel companies as part of a broad-based index type approach. So definitely I would suggest engaging with your employer and pushing for fossil-free, ESG, authentic options in your 401k. So you are not forced effectively to invest in fossil fuels, and your employer is not forced to invest in them as they match. So that's your main avenue if you're stuck investing with your employer's 401k system or whatever else. If you're in a nonprofit, it's a different type of system, but it still often is just a limited set of options that you have. So in that case, you really have to engage with your employer and try to get that set of options better. And finding the right person to do that can be challenging, but it's going to vary based on where you're working, and obviously the complexity of changing those options will vary based on how open your company is to trying to make sure their employees' values can be reflected in where they put their money for retirement.
Yeah.
that is a big piece of what needs to change. Actually, the group that I mentioned earlier, Hip Investor, Paul Herman is the founder there, and they have an initiative around green 401ks, and they've been including Etho in green 401k plans for companies, working with some other partners in that respect as well. So there are folks doing it. There is a whole lot of kind of shady corruption that goes on connected up to the 401k industry, where there's a lot of pay to play. Often the options that you see are options that are there because they've effectively been paid to be placed there. And there's different cuts of the management fees associated with those options that get divvied out. So that's something that we've been trying to navigate with Etho. Obviously, we don't want to get in the context of pay to play with what we're doing, nor could we afford to. But there is a lot of inertia in the financial system around offering authentic, more sustainable options, climate and otherwise, because of just the, in many cases, perverse incentives related to which options are shown to you to begin with, which don't necessarily align with your best financial interests or your sustainability interests. I don't know if you watched Last Week Tonight with John Oliver at all, but he did a great episode actually on just their own journey with their retirement plan for their employees and uncovering a whole lot of pretty shady business in the process. So that's a
I will
recommendation for your listeners out there.
I will check that one out. Thank you for that. So I'm going to ask you a bunch of questions in here, and it's all kind of connected, but feel free to just pick whichever piece of this, whatever direction you want to go in. And it starts kind of with the big picture of like, we need money to stop flowing towards destructive life-taking activities and start making it flow into regenerative and life-giving activities. So I'm kind of curious, just at like a very high level, who are the key players in the financial space? And could you please paint the picture of what they should be doing in your mind compared to what they're currently doing today? And just last couple of things in here is like, what would you say to these folks? What's the case to make to them to actually accelerate change in the right direction? And I guess just any advice you have for people listening who might be in the financial space and actually want to take meaningful action on climate, what would you say to them? So a lot in there, but it's all just kind of big picture, what needs to change and how do we make that happen?
So the biggest players in the financial world are the largest asset owners, and those, as I mentioned, are public pension funds and sovereign wealth funds. So here, where I'm based in California, the largest pensions are CalPERS, the Public Employees Retirement System, and CalSTRS, the Teachers Retirement System. And that's the case in most states around the US. And then around the world, you also have really large sovereign wealth funds like in Norway and Singapore. And ultimately, those huge pools of money, they're our money. They're public money. They're retirement plans for public workers, for example, here in California, and teachers. Like my mom was a teacher here in California. And I think we have a lot more leverage than we realize to make sure that that money that effectively is our money, paid for by taxpayer dollars for public employees, is shifted away from climate and other sustainability problems into solutions. And where the current state of the dialogue is that a whole lot of those huge, what are called institutional investors, pensions and sovereign funds, they're increasingly saying, yes, we care about climate change. We see overall ESG sustainability as a problem. And they're signing on to these big pledges like UNPRI and Climate Action 100 Plus that have tens of trillions of dollars connected up to them in terms of those asset owners. But right now, there's still this big gap, as I mentioned, between the reality of where their money is going and the rhetoric about where they say they want their money to go. And a big reason for that gap is a geeky financial term called tracking error. And tracking error is basically this measure of how well a given investment strategy corresponds to an index benchmark that it's measured against. And so, in most cases, those huge institutional investors have increasingly done the shift of moving money from more active strategies to what are called passive index strategies, basically these broad-based market strategies like Etho is as well. But they generally have, while making that shift happen, really constrain their portfolio managers to say, your job performance is going to be based on the tracking error relative to the underlying benchmark that you are supposed to be managed against. In a whole lot of cases, it's this global benchmark called the ACWI, the MSCI All Country, All World Index. And so basically, if you're a portfolio manager at a large pension like CalPERS or CalSTRS, or other pensions and sovereign wealth funds around the world, there's a good chance that your job performance is basically just saying you should perform more or less exactly as this benchmark performs, not worse, and really even not substantially better, because if you're performing better, that might indicate that you're taking on too much risk. And so you have all these big institutional investors investing public money with these tracking error targets. And they're saying, on the one hand, rhetorically, that we want to be a part of the climate solution. We believe ESG is important. But then still, they have these tracking error targets that are basically tracking also the job performance for all the portfolio managers at those institutional investors making decisions. And those tracking error targets are basically saying, you should be doing what you've always been doing. You should be investing basically just by buying the benchmark or something as close to it as possible, so that you're not doing substantially worse or even substantially better than the benchmark, which is what would sound crazy to a lot of people. On the one hand, they're saying we want to be really different and better in terms of climate, but on the other hand, no, you actually want to be exactly the same because you want to have minimal tracking error relative to your benchmark target. And so that really needs to change to shift the huge amounts of money, the tens of trillions of dollars that need to shift out of climate and overall ESG sustainability problems into solutions. We need to do away with tracking error targets related to conventional benchmarks and tracking job performance for portfolio managers relative to tracking error conventional benchmark targets, because that is really constraining what's happening. And that is the reason that the other largest player in this space, the index creators and index fund creators for the biggest investment products in the world, which are basically just investment products that invest in the most common indexes, that is the other reason that they're not creating indexes that are like Etho, really authentically taking climate and ESG into account from the bottom up, but rather they're taking out as little as possible and just shifting the weightings for percentages of which companies are in there and not fully divesting from fossil fuels. They're doing all those things with the funds and associated indexes that they put out there that are supposedly more climate and ESG sustainable, because they're trying to minimize the tracking error for the financial performance of those strategies relative to these common benchmarks like MSCI, ACWI, and S&P 500. And so you've got this perverse incentive ecosystem that keeps feeding on itself, where the biggest institutional investors are saying we want to be different and better for climate and ESG issues, but then we effectively also want to be exactly the same with their tracking error targets. And then you have the largest investment products creators that are out there, BlackRock, State Street, Vanguard, etc., putting out products that have these ESG and climate labels, but when you look under the hood, there's a whole lot of problems, because they effectively know their audience, and they've actually helped sell the idea to their audience that they should be minimizing tracking error and shifting towards just conventional broad-based index investing. And so you have large entities like BlackRock and State Street saying, we care about climate and we're trying to push towards ESG, but their bread and butter are the tens of trillions of dollars that are invested in their conventional index funds. So they're not coming out and saying strongly that everybody should be divesting from fossil fuels out of fiduciary duty. Instead, they're saying you should engage and stay invested in these companies, because that's how you drive real change. But they're not making that shift from engagement to divestment in the rhetoric because they effectively don't want this status quo system of tracking error and conventional index investing that has funneled tens of trillions into their investments. They don't want that status quo to change. And so that status quo really has to change if we want to shift the biggest pools of capital out of problems into solutions. And again, those biggest pools of capital, it's really our money. It's public money that is trapped in this zombie flow towards unsustainable investing. And so that all needs to be rethought.
Sorry to interrupt, but how do
Yeah,
we
go ahead.
fix that? And what do you see the best solution being? And, how do we make that happen? Who needs to get involved?
So how we fix that is one, engaging the recipients of those huge pensions in saying to the managers of those pensions, hey, we need to rethink this. We need to push the pension to divest from fossil fuels, for example. And that's happened a bit here in California with CalPERS and CalSTRS. You have had public employees and teachers engaging, trying to get divestment commitments. And you've had regulators to a certain extent trying to push things in that direction. But there still is a whole lot of, I think, really disingenuous rhetoric around engagement instead of divestment that's keeping that transition from happening. And a lot of scare tactics, probably if you go back into the dark money funded by the fossil fuel industry, that say, hey, if you divest, you're going to lose financial performance. Of course, all the data doesn't bear that out. It shows exactly the opposite. But that's one of the solutions, is particularly those that are recipients for pensions that are continuing to stay invested in fossil fuels and other polluting, dirty ESG issue area companies. They need to engage and say, look, this is my retirement money. You're violating your fiduciary duty by keeping it investing in these conventional ways. It's not enough to say you care about this stuff. You need to actually realign where the capital is flowing by re-incentivizing your portfolio managers and rethinking tracking error targets. Because tracking error targets actually, if you're looking at a target that both is trying to minimize outperformance and underperformance, it actually minimizes the ability to financially perform better. It constrains you to a conventional benchmark filled with fossil fuels and other dying companies. And it constrains you from the kind of strategies we're doing at Etho that historically have performed a lot better than those conventional benchmarks. Yeah. So that's one of the things that needs to happen. I think another thing that needs to happen is all of us that can move our money more freely than these large institutional investors, including just all of us as individual investors and family offices for wealthy individuals that have a whole lot of money in this world, and smaller institutional investors like universities and foundation endowments. We need to be shifting our money into fully decarbonized and ideally even climate positive strategies where every dollar invested actually has a net climate benefit and is also fully ESG aligned. And we need to be helping show that investing that way just financially performs better while also being climate and ESG target aligned. And so that's a big piece of what we're working on at Etho as our next step, is creating climate positive strategies that are also fully ESG aligned, that are accessible to investors of all sizes. And I think it has to start with us as individual investors, as family office investors, as smaller institutional investors. And then the more we help these strategies grow and show they perform and actually perform better, the more pressure we can put on the largest pools of capital, the biggest pensions and sovereign funds, to change the way they do things.
That makes sense. I'm glad I asked you that big jumble of questions because that was all very insightful. And I think, getting money going in the right directions is one of the most powerful things we need to start doing because that's the world we live in. So a bit of a left turn here, but I have one more question before we get to just a couple wrap up questions. And that is, a big part of what you do, I believe, is, scoring companies on their emissions and overall sustainability. So I'm curious, what advice do you have for companies to accelerate their progress? And, that can be the broad, like, what should the company be doing, but also maybe from the angle of just employees listening out there, do you have any specific advice for them on what they can do? And last thing here, take this in whatever order you want. But I feel like there's also potentially a difference between a large scale company and like a medium to small company in terms of the bandwidth they have or what they should focus on. So I'd just love to hear your thoughts on that.
Well, I think the overarching theme is every company, every investor, all of us as individuals should be pushing to get to net zero climate pollution as quickly as possible and ideally net positive, where our activities, our spending, our investment actually has a positive impact on not only getting to zero pollution, but actually removing pollution that's up in the atmosphere to get to pre-industrial levels. And there has been this net zero movement for governments and companies that has been accelerating. As I mentioned earlier, the targets are too far out there. In most cases, they're net zero by 2050. We really need to get to net zero now. And my biggest advice for companies and employees that are looking to push their companies to do more is to look at the new climate neutral certification standard. It's climateneutral.org. And they already have hundreds of companies that are signing on to get to net zero now. And that is a combination of a company tracking its climate footprint in a science-based, really rigorous way, and then reducing its footprint as best as it can, and then with really credible, rigorous offset projects, eliminating the remainder of its footprint that it can't reduce internally. And ideally, we get beyond just offsets to those payments going to carbon removal. So it's not just avoiding emissions somewhere else with an offset, but actual payment for removing that pollution that's already in the atmosphere. So in my view, really every company should be aiming to be a climate neutral company tomorrow and signing on to the climate neutral standard and going through the process of becoming certified. It's easier, obviously, for some companies, like a tech company that isn't as pollution intensive than an industrial company, but it is something that can be done now. It can be done in an incredible way. Those of us that are consumers, effectively all of us, we also can be making sure that we're trying to steer towards buying products for companies that have made that climate neutral commitment and already not just made the commitment, but taken steps to getting there as quickly as possible. That's my overarching advice for anybody who's leading a company or working at a company, that you can do a whole lot more now than maybe you realize. And climate neutrality and even net climate positivity is within reach with existing systems and technologies for most companies quite quickly. And those of us that are making shopping choices and investment decisions, we should also be thinking about factoring that into the companies that we invest in and the funds that we invest in. And that's certainly a big piece of what we do at Etho, is looking at companies that are aligned with the 1.5 degree warming Paris target and trying to bring in as many companies as possible that are not just net climate neutral, but net climate positive, because they're putting products and services into the world that are having a positive impact and reducing emissions. So that's, I think, my biggest message for companies is to become climate neutral certified. And you can check out climateneutral.org. It's a nonprofit that has been growing quite rapidly, and I think is really going about it the right way.
Quick follow up on that, because I know I read Dr. Jonathan Foley over at Project Drawdown. And I totally agree with you. I think the net zero by 2050 is too late. We need to move that up as much as possible. But I read something of his recently that was saying that we need to be wary of offsets. And I'm curious, do you know off the top of your head if climate neutral is making sure that companies are first eliminating as many emissions as possible so they don't have to offset that much? Because I feel like some companies, especially, I think there's some fossil fuels companies doing this as well, but they're saying they're going to be net zero by whatever date. And I feel like it could be used as some sort of greenwashing still. And so it gets important what the details are on, are they actually reducing emissions as much as they can first?
Yes, definitely the devil is in the details with any of these net zero claims. And there can be a lot of issues associated with offsets. One of my former lives was trekking around the world and measuring trees and measuring soil carbon. And so I've been involved myself in offset projects here in the US and internationally. And my view out of coming from that direct involvement was there are a lot of BS projects in the offset world that are giving carbon credits for things that would happen anyway. Um,
Yeah.
with that said, I think it is essential that we have a mechanism that pays to reduce pollution. And ideally is not just paying to reduce pollution somewhere else, but actually paying to remove the pollution that's already up there. And that type of activity, it's hard to argue that it's not additional. So that is really the essential question with offsets is what's called additionality, whether or not the money that's going towards an offset is actually funding the activity and making sure it happens, or if it's just giving extra money to something that would happen anyway.
Right.
So with climate neutral, they definitely are doing, I think, as best a job as they can of making a standard that both is usable and attainable for businesses, including small and medium-sized ones, um, but is really scientifically rigorous in what it's requiring businesses to do. So the first step is doing the climate accounting, just tracking your climate impacts as a business, your climate footprint, and doing that in a way that's both accessible and rigorous and defensible. The next piece of it is getting recommendations on how to reduce your company's footprint as best as possible before focusing on the offset piece. And then the offset piece to get to full climate neutrality, which is the only way to get to climate neutral or climate positive in the foreseeable future, is offsets have to be a part of that equation, because none of us as individuals or no company can really get to climate neutrality unless the company itself has a product and service that's drawing down pollution in some way. So given that offsets or direct payments for carbon removal need to be part of the equation, I think what climate neutral is doing is trying to be as rigorous as possible about what type of offsets from what providers are allowed to be counted for the climate neutral certification. And full disclosure, I'm a fan of what they're doing because I did help them set up this scientific advisory board to ensure that the climate accounting and the offsets allowed into their system are rigorous and defensible. Nice. And not a bunch of BS. So I've seen internally what they've done. I've been really impressed by their team and their process, and trying to strike the right balance of something that is accessible and usable for companies, including smaller companies and even startup companies, but then also being really rigorous and credible. And they're continuously revisiting their certification system and their tools to try to continuously improve.
That is awesome. I love to hear that. All right, so final question, and I just want to say first, I guess, thank you so much for your time. I really appreciate it. I've learned a bunch here. I'm sure everyone listening has as well. But I will give you the last word. Do you have any final key takeaways or message for folks or calls to action that you want to leave everyone off with?
I think my key takeaway for climate investing and sustainable investing broadly is just do it, whether it's with Etho or with somebody else. All the arguments are that if you invest in more efficient, sustainable companies that are authentically more efficient, sustainable, not just better at marketing themselves that way, on average, you're going to do better from a financial return perspective. And you also will be aligned with your values and the world that we all want to see. So there really is no strong argument against smarter climate and overall ESG sustainable investing. It's really the wave of the future, the thing that every investor should be doing. And it's just a matter of how you do it and the context that makes the most sense for you, and how you can encourage even bigger flows of capital, whether it's connecting with your friends or your employer or your pension to do the same, and supporting regulators as well that are passing laws that are pushing money in these directions and trying to enhance transparency and accountability. So my main take home message is just climate and sustainable investing works. It's what we all should be doing, and it's something that I think is going to be a continuous process of improvement. And what I'm excited about most is this transition towards climate positive investing and overall ESG integration that we're working on with Etho right now, and making that type of investing accessible to investors everywhere. But bottom line is sustainable investing is just the smarter way to invest. So we all should be doing it, and there's no reason not to do it right now.
Here, here. Well, thanks again for coming on the show and for all the super important work that you and the team are doing over at Etho Capital.
Thanks a lot for your great work as well, and really excited to continue to see the crowdsourcing sustainability community grow. So thanks for helping that happen, and excited to see where this goes next.
Me too. Absolutely. All right. That is a wrap.